Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's start with a little look-see at the weekly fund flows report from James at CoinShares, continuing to see positive weekly inflows across all products. As James noted in the open there, ETH finally seeing some inflows, likely thanks to the ETF 180 about face by the SEC. Still seeing healthy inflows into iShares and Fidelity. Grayscale's not at zero yet, so we're still seeing outflows there. But overall, this is what we want to see. We don't need billions and billions of dollars every week. Just a slow and steady stream should be good enough. Looking at the cumulative 30-day flows from Bold report here, still solidly green. This is what we need. Just continuous buy pressure is plenty. We don't need some crazy spikes in flows every single day. We did have a nice pop today. A bunch of weird stuff, right? We had GME up again a bunch in after hours weekend pre-market trading, however you want to think about that. We had a bunch of glitches at the New York Stock Exchange, a bunch of stonks going to zero literally, temporarily, thanks to those glitches. So maybe not for that. We would do a little bit better here. I think that spooked a bunch of people. Never a good sign to see that, real or not. But in any case, we're still plenty bullish here on BTC, holding above the daily cloud. Flag, cup and handle, inverted head and shoulders, all of it is bullish continuation in my book. So we look good there. BitX starting to look better on the daily, probably get a daily TK cross here in the next couple days. As long as we can hold these highs, that's the 2x ETF. The 4 hour also slowly but surely starting to tick greener here again. And that's what we like to see. BITO, just sort of round the horn here on some other stuff. BITO was down by quite a bunch today. I assume that has to do with quarterly roll of the futures contracts. Don't know why else that would be. But there's certainly a decent case for an inverted head and shoulders there. Pre-TK cross, Kumo breakout, IBIT. This chart to me looks pretty good. I don't know about anybody else, but again, it's the same thing with cup and handle up here. It's probably the best argument. You'd want to see anything above 41 on that one. Floki was up a bunch today. ENA, I didn't show this yesterday, but this is the chart that I had in mind. This is breaking out. So there are some things, BNB's breaking out a little bit. And then this is GME. And I looked at this, I don't know, Wednesday or Thursday last week. And I was thinking to myself, well, maybe there's some sort of chart pattern down here, something, I didn't play this. I'm not ever going to play this, but I thought about bringing it up. Then I'll bring it up now just because it's interesting how it actually played out, measuring the depth of whatever pattern this happened to be higher. And you got your target there on open, and wouldn't you know it, the hourly cloud also giving you an edge-to-edge trade. Now that's some 50% fib from high to low. My guess is from the recent high to the recent low. So some interesting activity all around in the market today for sure. Before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. I always like to check with the volumes on any given day. One thing that I keep bringing up, and I always just remember from the bear market, Bitcoin was never at the top of the heap. In the bear market, it was always stable coins that you'd see up here, USDC or USDT, at least on Kraken. So it's a good sign to see continuous volume on a day-to-day basis. And for the most part, it's all about BTC, ETH, Sol, and a bunch of meme coins. Not really much else going on. In most other cases, we can look against Bitcoin, see if anything's up today. I think OMG had a delisting on another exchange today. But for the most part, not a lot of positive relative to BTC. And I really don't think you're going to see that until this is EOS BTC. And this is your fate, if you become a community member with a coin that just continues to bleed and bleed and bleed. Unfortunately, that's the reality, and this is why Bitcoin maxis exist, okay? That's just an expectation for most of these coins. It's just continuous bleed forever against Bitcoin, which is just why a lot of this stuff is a great trade. It's a great cycle watch on the meme coin side or whatever, but I would definitely not hold those through any sort of bear market. Looking at the calendar in the meat space this week, a lot of employment stuff, namely the most important, the employment report, employment rate, wages, all this stuff very, very important for the Fed, for econ data watchers, unemployment rate being the most important. And we still sort of need to thread the needle. A lot of doomers don't think it's possible. They think we're already in a recession, but we need to thread the needle between seeing softening in the labor market while not entering a recession, right? That would be the soft landing argument. You've also got some employment numbers Wednesday coming. We're seeing these surveys, ISM, PPI, PMI, whatever, all sort of coming in soft. And that is suggestive of recessionary conditions. Finally, we have the GDP. I say finally just because, again, the doomers, all I hear, I listen to a lot of stuff every day. My whole day is basically listening to other financial media, crypto or otherwise. And they're just this cacophony of people still who are basically saying the sky is falling, it's over, guns, antibiotics, and canned goods. That's what you need to get. So finally, there's something in the data that they can say, hey, this is a softening of GDP. And maybe this is why, in combination with PMI and other data, we're seeing a weakening of the DXY. US dollar index looks like it's headed lower just based on technicals. It was already in the daily cloud. It's still in this massive mega range. So on the crypto side, we aren't recession proof, certainly. So we don't want to see the DXY melting down because of a recession, but we do want to see this softening, right? We want the soft landing. We also luckily have UJ turning a corner. If you remember, a rising UJ, an out of control UJ risks the Bank of Japan selling US treasuries to fix the imbalance effectively. That would mean yields higher on our end of the pond and risk assets likely lower. So to see UJ sort of come down on its own is a good thing. Maybe this is a massive mega rising wedge versus the ascending triangle. Still looks okay on the daily cloud, but as long as this is not moving to infinity, we should be okay. That we can remove one scare from the chessboard. Okay, there's other geopolitical stuff, there's nuclear stuff, there's all this other stuff going on, but hopefully we can remove this concern. Yields also coming down to this is the 10-year yield. Technicals for this again look soft, look weak, look like bearish continuation, potentially an inverted cup and handle up here, measures to around 4%. We'll take it. Yields down means prices up, which is why we're seeing basically the opposite on TLT. We're seeing kind of a cup and handle type structure. Down here, we're into the daily cloud. We're not bullish yet, but we are trying on TLT for sure. Now you'd think things that were rate sensitive would be doing better today. Things like regional banks. Regional banks still not doing great. This is the KRE index. I forgot to include the holdings here, but there's a ton of regional banks in here. The most rate sensitive in the financial sector. In this chart, based on technicals, you wouldn't know it that rates were down on the long end today. There's the proxy for the bank balance sheet is partially what TLT looks like, which is why we're seeing a rise in unrealized losses on banks. This is from the FDIC, a quarter-over-quarter rise in unrealized losses. We've also got a slight uptick in troubled banks. I think this is recent data. So that's probably why the KRE isn't doing great, but even the IWM isn't doing great. So maybe all of these need JPOW to bring rates down first, but it is kind of odd we're not seeing any sort of reaction from any of those. This is the yield curve. The black line, the thick black line, is where we're at today. You can see we've been all over the belly of the curve, upper, lower, bear steepener, bull steepener, slight bull steepener, as in the short end coming down a little bit here. But overall, the yield curve is still very much inverted. We're not seeing the short end come down to meet the long end just yet. So these are rate probabilities for the meeting in 2 weeks, pricing in neither a cut nor a hike. Meeting after that, we'll see. Depends. We get CPI on the 12th. We get unemployment Friday. We get more data before the July meeting. It will probably be more of the same. It will probably be higher for longer. We're headed in the right direction, but we're not quite there yet. Unless the unemployment data is dramatically higher. That would be my expectation. So I wouldn't think too much is going to change there in between the meetings. And this is really the main reason why we need rates to come down in the United States. 9.3 trillion in government bonds maturing in the next 12 months and have to be refinanced. That's a lot of cheese, It's much easier to do that with rates lower. Arguably, it's easier to inflate the debt away, but this is quite the bear with the ball still rolling here by the time they eventually bring rates down. And as Alex points out here, relative to GDP, I laugh because I don't know what else to do. What are you going to do? People have been saying that this doesn't matter for the past 40 years. Eventually it's going to matter. I don't think we're going to go another 40 years in the current path without something blowing up. So I think it's going to matter in our lifetime, certainly. Trueflation has ticked down significantly to 2.19, definitely on the lower end that we've seen in the past year. So we're certainly headed in the right direction on Trueflation. The nowcast for CPI is slightly down from 3.4 to 3.36, 3.326. So we're headed in the right direction on CPI. Core, we are not. PCE, core PCE, we are not. And PCE, we are slightly. So it depends what the Fed wants to use. Do they want to pick a range rather than exactly 2%? Do they want to continue to squeeze things and risk the labor market exploding, right? This is up to them. I hope they get asked these questions on the 12th. Based on Trueflation, we're almost there. I think the problem is if you bring rates down, then what happens with inflation, right? We may or may not save the jobs market, and it may or may not matter for inflation if rates come slightly down. So it may just be irrelevant, right? At this point, it just might not even matter. But it's more about vibes, It's more about vibes. This is the yield curve 10-2 with unemployment. So yield curve very much still inverted. And what you'll notice is typically you don't see unemployment rising until much after the yield curve uninverts. So another weird part of this cycle may be some different behavior there. For instance, if we see the yield curve continuously being inverted with unemployment rising, what does that mean? I don't think we've necessarily seen that before. This is the 10-year in 3-month for those who prefer this yield curve, also very much inverted. So from that perspective, we look okay. Now you're probably going to get people, should unemployment rise to, 4.1 or 4.3 or something, you're going to get people talking about the Somm rule. You're going to get Claudia Somm on the financial media saying this time is different. That's probably going to happen. The Somm rule is when the 3-month moving average rises by 0.5 percentage points relative to the previous year. This is just a graph for that. You can see historically that is been pretty much dead on the money for recessions. So we don't want to see that. We don't want to see markets react to that. So again, we're threading this needle between we want the Fed to cut. We think we want the Fed to cut from a place of strength, certainly, rather than a place of weakness. Reverse repo on the liquidity side hasn't really helped us out at all. Although you could argue, maybe if we zoom in, enhance, we're down slightly on reverse repos over the previous week, almost to a multi-month low. Not quite though. So, is the next 300 billion going to help us out on the liquidity side? Yes. Is it probably irrelevant at this point? Also probably yes. We've squeezed most of the juice out of this reverse repo slush fund at this point. As many people have kind of already hinted at and alluded to, the next rally may be fueled by the money on the sidelines people in money markets. This is retail money markets at 1.8 trillion. It ticked down slightly thanks to taxes and taxes being paid. It'll be interesting to see whether or not 1 cut, 2 cuts, 3 cuts, or no cuts, or a hike, right? How will retail money market funds behave there. My guess is it's going to take quite a lot in the cuts department to bring money out of retail money markets, but I could be wrong. But this is the dry powder indicator that I would pay attention to. Looking at US liquidity and global liquidity, US liquidity has ticked up slightly, ever so slightly. Global liquidity, basically flat, the green line there. And then there's BTC in the orange. So we're still basically ranging on all fronts there. As far as markets are concerned, S&P. So on Friday, I didn't even mention this, but on Friday we had some end of day, end of month buying, massive volatility in the final minutes of that day. Today we had the NYSE data scare. But at this point, based on the technicals, we're almost there. There's certainly room for higher. I'd assume we'd end the year higher. It's just at this point we may be slightly overextended relative to the moving averages. We've kind of lost momentum. On the weekly, we have the old cup and handle. We're still bullish. Trend is still bullish. Don't get me wrong. We may need to start to reconsolidate up here a little bit before attempting to push higher. I've seen a bunch of these presidential cycle charts, and we're kind of into this June-July pocket, which would make sense for more sideways relative to where we are now. Still a little bit of up in the rest of the year. On the crypto side, we just need this to not completely collapse, right? 5K, 4,800, probably fine. We would certainly eat some pain on the downside. But to see this thing roll over back to sub 4,600 or something would not be good. One of the reasons it might roll over hard is if NVIDIA rolls over. I don't think it will. I think NVIDIA will continue to do fine. I'm still hearing people's worry about NVIDIA rather than saying, it's the next tech miracle, right? Bubbles don't usually end with people being worried about where prices are going. Bubbles usually end by everybody being excited about something, massive euphoria. We're seeing that certainly by people who have done well. But if we look at the S&P sectors, the semiconductors quickly approaching the heaviest weighting, with software being up there as well. I'll take a look at the software ETF today. Doesn't look great. IGV, tech hardware down there. So if semis start to roll over, then the S&P may do less well than it has been doing. Looking at the Qs, very similar type of setup. TKC clamp probably goes nowhere for a little while here. Worst case would be a head and shoulders eventually. Super early on that call. This could take us into Q4, and I don't think Q4 is going to be particularly bearish. So we'll see, but just something to watch out for. I just think consolidation is probably what's going to happen over the next couple of weeks here. DJI looking also not super happy to be up here. A little bit of an M double top. Definitely a TKC clamp on this one, more so than anything. So I think we need a little bit of a breather across the board. Something that doesn't need a breather at all, hasn't needed a breather other than March, April, May was NVIDIA broke out. Still holding those highs, holding very much near all-time highs. Something you typically see in cycles, you get these pauses. You can't see the full pause here in 2023, but that was about a 6-month pause. This was about a 3 to 4 month pause previously, and now we'll probably continue to see faster and faster moves with smaller and smaller consolidation periods. And that's also a sign that we are getting closer to the end, but this could just keep going for another 12 months, 18 months, who knows? We still have people trying to short this, which God bless them. They're really helping push this higher, and it looks fine up here. It's not for me, but it looks fine. There's no real issues with that. Apple kind of has this ugly chop for the past year. It's slightly up since June 2023. Without that buyback, I wonder where they'd be. But this chart just isn't for me. It's just a massive range. At the Kumo breakout was probably your best bet to get an entry here. Overall, I think this probably just chops flat or up in the near future. Microsoft looks okay. It doesn't look great. It doesn't really look like an entry for anything here. It just looks like a range. Previously, I had this drawn as kind of a head and shoulders, but now maybe this is a right angle broadening wedge or something. It doesn't look like it wants to resolve bullish, and that's kind of how I feel about most of this stuff in the near term. I think it either needs to just consolidate sideways in a pretty big range or break down, right? I just don't think most of this stuff wants to go higher. I don't know anybody who's excited to buy most of this stuff up here either. Amazon kind of the same. It hit its high time frame inverted head and shoulders target a while back, and now it's just kind of chilling, you know. M double top, maybe a diamond top eventually, back into the daily cloud. Just not really exciting up here. Doesn't look like an entry to me on the long side, certainly. And if I was long, I'd be out based on the move into the cloud there. Meta, kind of the opposite. It's just now emerging from the cloud. But again, is there anything up here? This just looks like a massive range, potentially, again, a diamond top. Just looking at the cloud, you could say, well, if we get a bullish TK cross the price above cloud, that's go time. I'm not going to disagree, but I don't think this one's particularly for me either. Google, unlike the indices, where they are closer to their cup and handle targets, Google is just breaking out of its cup and handle target. So it's got a ways to go. It's not going to get there in a straight line, but on trend, it probably looks okay. The one caution here would be it's pretty far away from the TK lines. Netflix, much of the same. I just don't know anybody who's excited about buying up here. It's in a trend channel. It looks fine trend-wise, just not for me. Now Tesla, company I don't particularly like. Elon is a clown. I'm not going to go into that, but this chart looks pretty good from a potential long setup, inverted head and shoulders, diamond bottom. Elon's pay package is coming up, the vote on that. I don't really care about anything else other than the chart, so I could be very wrong here. I would not follow me on this trade, but I am a long Tesla options because I like to gouge my eyes out. But a true test of the technicals versus the fundamentals. It's also in the daily cloud, has been for a week here. Stop loss on this would be anything below the Kijun, below the cloud. So I'm giving it a shot. Technicals versus personal bias. We'll see what wins out. SMH, semiconductor ETF, mostly NVIDIA. So it's going to look like mostly NVIDIA. Looks fine. I still, again, know people who are trying to short this stuff. You can try to be a hero. I don't think that's going to work out too well for you, but hey, go for it. IGV, this is the software ETF, mostly Microsoft, Oracle, Adobe, Salesforce, Intuit. This chart does not look good to me. This looks very much like a head and shoulders that's been forming for the past 6 or 7 months at this point. It's below the daily cloud. There's just nothing about this chart that looks good to me. I don't know if it necessarily breaks all the way down here, but it does not look good on the long side. Then we've got oil, which continues to sort of surprise a lot of people. We had some OPEC cuts come over the weekend. Oil continues to slowly drift lower, still below the weekly cloud, and just not a lot of technical bullishness here that I'm seeing, which is good for the US inflation story. Gas prices still holding slightly down week over week, month over month, 3.56, $3.56 based on the AAA prices. We're seeing air travel at all-time highs. So everybody that thought that travel would never recover after COVID is incorrect, clearly. Lots of people still traveling, that not really affecting the oil prices, and just randomly, tangentially, Manheim Used Car Index still has a ways to go to return to the pre-pandemic trend, on its way down, but still quite elevated up there. In the same vein of energy, XLE, mostly Exxon, Chevron, ConocoPhillips, this continues to be allergic to breaking out of its ascending triangle. Maybe this is a falling wedge. That's what I'm hoping for anyway. You never want to see anything come back to inside of the pattern like it is now. So it's definitely looked better on the breakout than it does here, but it's better for the inflation story that this is probably looking weaker. Then lastly here, WGMI, mostly CleanSpark, Iris, Marathon, Cypher. Really not much of anything over the past couple weeks. It is trying to start to maybe think about breaking out, trying to get above the daily cloud. CleanSpark and IREN look certainly better than WGMI. What really interests me isn't how it looks today, it's how it may look, how the miners may look if and when we get a breakout above 74 on BTC. You know, what does WGMI look like if we're at 76 or 80 on BTC? And that's what I think a lot of people are preparing for the expectation of bullish continuation because of the cycle. And hey, bonus, you even got some NVIDIA in this one as well. So not a lot of tradable setups in my opinion right now, and legacy. There's always something somewhere if you look hard enough. Tesla, oddly, is probably the best looking setup, and for a while it just was terrible looking, so that makes sense. But that's all I got for this one. Like, dislike, comment, share, subscribe, and happy trading.